Assalamu alaikum. This is lecture 21 of Advanced Cost and Management Accounting. The topic we have been discussing is budgeting. We have seen the various ways in which the budget process can be evolved and the various uses and how advantage the budgets can give to the organization. We have talked about the activity-based budget, and we have talked about what were incremental budgets and the kind of disadvantages and criticisms there are of incremental based budgets and the advantages of activity based budget. It's of importance that the organizations, if they are going through this fairly lengthy exercise of budgeting, and we said that this can take for the larger multinational organizations anywhere up to or perhaps even more than 6 months. So such a large amount of time is spent on the preparation of the budgets. Therefore, it's important that the organization makes this a useful tool. The way in which to make it useful is to ensure that resources are being allocated on need basis and they are provided where they are necessary, and inefficiencies and wastages are avoided and they are removed. This can, of course, only be done if the budget is looked at in detail and the budget looks at also the activities and not just the expense. If we are going to look at just the expenses and we are going to look at last year and one expense and incremental percentage added for increase in costs, and we have the expense for the next year, this will be a little less useful and it will allow wastages and inefficiencies to be accepted in the organization. We have also said that there can be a situation where if you have set a budget allowance and this allowance is not accurately based on need, the organization might find that towards the end of the period, it has not quite reached the expense to the level of the budget, and there would be a temptation to incur the expense regardless of need in order to meet the budget allowance, because managers feel in a way they have the authorization and the authority to incur that kind of expense. So in order to remove inefficiencies and in order to remove wastages, activities should be looked at, activities should be based, and not simply the kind of expense and a percentage increase and looking at base levels of previous periods. We emphasized that the budget is going to be based on the sales figures. So sales budget is going to be the first budget that is going to be prepared, and others are going to be based upon it. A very important aspect of budgeting is the cash budget. The cash budget contains details of all cash inflows and all cash outflows. It highlights, therefore, what would be the periodic balance of cash in the organization to enable it to utilize the balance, invest it appropriately to earn a return, and on the other hand, where shortages can be identified, then to make arrangements to fulfill and meet those shortages if they are on a temporary short-term basis. Of course, where the organization finds that the shortages are on a longer-term basis, they might mean that they are having to incur a kind of expenditure which is ongoing and it's not being met by the current inflows. And so longer-term borrowings and longer-term financial arrangements will need to be made for that. The cash budget is an extremely important budget. Cash is one balance which we said previously organizations may find they want to regulate on a daily basis. They would want to know what is the balance at the end of each day, and what is the available or necessary inflows and outflows where arrangements need to be made either for additional cash or for investment. This cash budget very often requires calculations, it requires various estimations in order to be prepared. Also, from an examination point of view, very often students can be required to prepare cash budgets in the examination. Cash budgets, because several workings need to be done, several aspects need to be worked out and calculated to incorporate into the cash flows. We are going to look at another example, a detailed example of a cash budget, how a cash budget is prepared. We will look at one question with the information in detail, and we are going to then proceed to prepare a cash budget from that information. This will show students how the various types of activities need to be interpreted from an examination point of view, and how calculations can be arrived at to find the balances of inputs and outputs into the cash statement. Our example is that of preparation of a cash budget. The company we are looking at is called Qadar Bakhsh Limited. The management of Qadar Bakhsh Limited has been informed that the Union of Direct Workers intends to call a strike. The accountant has been asked to advise management on the effect the strike will have on cash flow. The following budget data was made available. 3 weeks data is available: week 1, week 2, and week 3. Sales: week 1 400 units, week 2 500 units, and week 3 400 units. Production is 600 units in week 1, 400 units in week 2. There is no production in week 3, which implies that strike will commence in week 3. The strike will commence beginning of week 3 and will continue for at least 4 weeks. Sales at 400 units per week will continue during the strike period until stocks of finished goods are exhausted. Now we will look at the preparation of cash budget. We are going to take the case of this company called Qadar Bakhsh Limited, and we will see how in the event of a strike a cash flow should be prepared. This incidentally provides you the usefulness of cash flows, that in situations such as this, where a strike is going to occur, where we expect production to be seized, what would be the impact on the cash flow, and therefore the usefulness of cash flows to the organization. In this example, we have been given 3 weeks data, 3 weeks of production data, 3 weeks of sales data. We are told that the strike is likely to commence in week 3, so there is no production in week 3. Therefore, when we are looking at costs, when we are looking at our cash flow, our production costs will be limited to the production in week 1 and week 2. This is the basis. Sales, we have been told, are going to continue. Sales will continue for the duration of the strike as long as there are inventories available. So in other words, we will have opening inventory, what we're starting off with, plus we will have 2 weeks production, and that will be the total amount of inventory available. And we have been given a budget data for sales. They expect to sell 400 units in week 1, 500 in week 2, and they expect to sell 400 in week 3. This week 3 sale, of course, is going to depend on the availability of the inventory, as there will be no production in week 3. Production will stop at the end of week 2. The current stock of finished goods is 600 units. So we will have 600 units as opening inventory plus 2 weeks of production. Selling price of the product is ₹60, and manufacturing costs is made up as follows: direct material 15, direct wages 7, variable overheads 8, fixed overheads 18 to give a total manufacturing cost of 48. Included in the cost is the per unit cost of fixed overhead. Now, we have discussed this before. It's important to bear this in mind and to remind ourselves fixed overheads will remain fixed for that given period and for that given level of production. And therefore, it is advisable and possible to arrive at a per unit rate in order to allocate this to products and on a per unit basis. Don't forget that fixed costs must be looked at in detail when there are changes such as shortages of production, when there are stoppage of production and things like that. Where production stops, you expect that fixed cost, or at least some of fixed costs, are going to continue. You can think that salaries will have to be paid of those people who are engaged, the management salaries. If there are any rents, those are going to continue. The depreciation of plant and machinery, etc., is going to continue. Utilities for offices and other office-related expenses are going to continue. But on the other hand, some of the fixed costs will also be reduced. For example, if you are not producing, production has stopped due to strike, then the fixed cost that perhaps relates to the utilities of the production hall, if that has been shut down, that might not be taking place. Any fixed costs relating to the cleaning, that might be shut down, and therefore there's no cleaning, and that might be reduced. So there might be some costs, the utilities and other maintenance, etc., cost might be reduced. So there might be some costs which, when production is shut, can be reduced, and some, of course, that cannot. Direct wages in our case have been regarded as a variable cost. So when production stops, direct wages will also stop and will not be incurred. The company operates full absorption costing, and the fixed overhead absorption rate is based on budgeted fixed overhead of 9,000 per week. The company operates fixed absorption costing, and we are now familiar with this, that fixed overhead absorption on a full absorption basis will mean that the fixed overheads are absorbed into the per unit cost. Per unit cost, we said a rate can be established, and now we are told that this is based on a fixed overhead expense of 9,000 per week. This 9,000 per week has been allocated on a per unit basis in the price structure that we saw earlier. So we saw a fixed overhead portion within the cost structure, leading us to the total cost. That is showing you that 9,000 was the basis of the fixed overhead expense per week. So the number of units you expect to produce in 1 week, that is going to provide you the rate of fixed overhead absorption. Included in the fixed overheads is 700 for depreciation of equipment. During the period of the strike, direct wages and variable overheads would not be incurred, and cash expended on fixed overheads would be reduced by 1,500 per week. We are going to prepare a cash budget. A cash budget will then identify only those items of expense which are cash based. So what about depreciation? Is depreciation going to have any effect on the cash? Of course it is not. The depreciation is an allocation of the cost of the asset incurred at the time of purchase. And after that, it is merely an allocation to the different periods over the useful life of the asset. So when we are told that 700 in the fixed cost relates to depreciation, and we prepare our cash budget, then in our cash budget, we are going to ignore this 700 cost because it is not related to cash. So our fixed overheads of 9,000 per week will be reduced to 8,300 per week, as 700 relates to depreciation. During the period of the strike, direct wages and variable overheads would not be incurred, and the cash expended on fixed overheads would be reduced. Variable expense, when you are going to stop production, by its very nature implies that variable expense is going to stop. So if we are looking at wages as variable expense, that means that while the strike is in process, there is no production, there will be no wages expense. All the variable expense will stop, and in our example we are told that from the fixed cost, 1,500 per week will be reduced. So our total fixed cost was 9,000. 700 related to depreciation, that we will ignore, and in the period of the strike we are going to reduce our fixed overhead expense by another 1,500. This is the information that now is going to be used in our cash budget, preparing the cash budget for the period showing the impact of the strike. The current stock of raw materials are worth 7,500. It is intended that these stocks should increase to rupees 11,000 by the end of week 1 and then remain at this level during the period of the strike. All direct materials are paid for 1 week after they have been received. So looking at the expense on raw materials, we are told that currently they are worth 7,500 and they are going to be increased up to 11,000. This implies that an expense of 3,500 will be incurred in order to raise the raw materials from the value of 7,500 to 11,000. This is for week 1, and we are told then thereafter they will remain at this level, at 11,000. So the expense to raise the raw material level only relates to week 1. Direct wages are paid 1 week in arrear. It is very important in the cash flow to take into account the timing of the cash input or output. So it will need to be reflected in the period in which it is occurring, as opposed to the period to which it relates. In other words, we are being told that wages are paid 1 week in arrear. So the payment of the wages is going to be 1 week after the workforce has worked for 1 week. In other words, the payment for week 1 will be made in week 2. This is what payment in arrears is. Cash flows will always take into account the effect of and the timing of the cash flows. So whereas the expense might relate to week 1, but because it is paid in week 2, the cash flow for week 2 will show the payment of wages and not week 1. We'll talk about this a little later on also, that there might be a difference between the time in which the expense is incurred for the organization, that means a liability has arisen, and the time of its payment, which might be subsequent. So it's important to realize cash flows are going to take account of the timing and reflect the payments as and when they occur. All relevant overheads are paid immediately as the expense is incurred. All sales are on credit. 70% of sales value is received in cash at the end of the first week and the balance at the end of the second week. So once again, we are going to take account and keep in mind the timing of the cash flows with respect to overheads and for sales. When the question tells us that overhead expenses are paid as incurred, that means the payment is made in the period in which they are incurred. So the week 1 expense of overheads will be paid for in week 1 and the cash flow will reflect this. For sales, we are told that sales are not on a credit basis. A credit basis implies that the receipts will be after the time of the sale. And we are told that 70% of sales are 1 week later and 30% of sales receipts are after 2 weeks. So we will have, for example, whatever sales made in week 1, let's say 100, then 70 will be received in week 2 and 30 will be received in week 3. That's the effect of the credit period that is being offered for sales. So cash flow is going to emphasize, and they are going to record the receipts and the payments at the time when cash flow arises. The current amount outstanding to suppliers is rupees 8,000 and direct wage accruals amount to 3,200. Both of these will be paid in week 1. Now we are told of the current payments due. Already we have some amounts owing to suppliers and we have a certain amount owing on account of wage. Wage accruals means that the workers have done the work but the payment is yet to be made. This is the accruals concept. People must have covered this in their financial accounting. The accruals concept where the liability has arisen because the services have been consumed but the payment have not yet been made. So the suppliers outstanding amount, we are told, is going to be paid in week 1 of 8,000 and the 3,200 relating to the accrued wages will also be paid in week 1. The current balance owing from debtors is 31,200, of which 24,000 will be received during week 1 and the remaining during week 2. The current balance of cash in hand and at bank is 1,000. Credit sales means there will be debtor balances, the amounts that are expected from customers from debtors. We are told that this balance is 31,200 and we are told that 24,000 out of that is going to be received in week 1. So that cash is going to be included in the receipts of week 1. The balance that amounts to 7,200 is going to be received in the following week, which is in week 2. So the cash budget is going to reflect week 1 cash receipts of 24,000 and included in the week 2 receipts will be the 7,200 from this current outstanding amount. Again, we are told that the cash balance is rupees 1,000 on cash in bank. So our opening balance on cash in bank will be 1,000. The opening balance will be the starting point. To that, we are going to add the receipts of week 1. The expenses will be deducted to arrive at the balance at the end of week 2. Similarly, the balance at the end of week 1 is going to be the opening balance for week 2. And we are going to then take the receipts for week 2 and deduct the payments of week 2 to arrive at the closing balance of week 2. This will be done on a weekly basis and cash statement will then be prepared for what we expect the duration of the strike to be. Required. A1. Prepare a cash budget for weeks 1 to 6 showing the balance of cash at the end of each week together with a suitable analysis of receipts and payments during each week. This now brings you to the requirements in the question. In any question at the examination time or in the assignment time, it is very essential to have a very good look at the requirement. After all, your answer should be based on the requirement. So very often the question can be large with a lot of information, nearly as in this case it is, and a lot of information is provided, and therefore it is essential to keep your focus on what is the requirement of the question. So read the requirements very carefully and make sure that you are providing the answer according to the requirement. In this case, our requirement shows that we have to prepare a cash budget, and that should be from week 1 to week 6. So we are required to produce a 6-week cash budget, and that's what we will prepare. Part 2. Comment upon any matters arising from the cash budget which you consider should be brought to the management's attention. And B. Explain why reported profit figure for a period does not normally represent the amount of cash generated in that period. The next part of the question requires you to comment on the cash flow. So there is a need to examine the cash flow to see the inflows and outflows and make whatever appropriate comments. And part B of the question wants you to comment on why there should be a difference between the profits and the cash. This is a matter of accounting principles and a matter of accruals principles, the matching concept, those things that we should talk about in answering this part of the question. The solution: cash budgets for week 1 up to week 6. As that is the requirement of the question, there are 6 columns, each for one individual week, starting from week 1 right up to week 6. Receipts from debtors we are showing here as 24,000 in week 1, 24,000 in week 2, 28,200 in week 3, 25,800 week 4, 19,800 week 5, and 5,400 in week 6. This debtors figure has been arrived at by making a separate working for the debtors for each week. This working is going to take account of what is the opening balance of debtors, what amount is expected to be received for each week, and what is the amount that is received in the following weeks. So just in a while we are going to examine the working to see how the debtors figures have been arrived at. Payments to material suppliers, 8,000 we were told are given in the question in week 1, 12,500 in week 2, and 6,000 in week 3. Again, we will look at some working to see how this payment has been arrived at, because we are told that there is credit period and payments are made subsequently. To direct workers, this is the payments for direct workers. We were told that workers are paid 1 week in arrear. So again, we will see a small working that will show us what is the payment due in the week and when it is actually going to be paid. Variable overheads, we were told that they are paid as they are incurred. And fixed overheads, we can see are 8,300 for week 1 and 2. And when the strike starts, it is 6,800 from week 3 up to week 6. If you remember, the fixed overhead expense was said to be 9,000 per week. And then there was 700 for depreciation. So we said depreciation is going to be deducted when we are preparing the cash flow and the cash budget. So 9,000 minus 700 shows you that week 1 and week 2, the fixed overhead expense is going to be 8,300. And there was information that once the strike commences, the fixed overheads will be reduced by a further 1,500. So from week 3, the 8,300 will be reduced by 1,500, and the amount will be 6,800 then from week 3 up to week 6, and this is going to continue. So this is the expense which will not reduce further from 6,800 and will continue to be incurred regardless of whether there is production, whether there is sale. We can arrive at the total payments then: 24,300 in week 1, 28,200 in week 2, 15,600 week 3, and 6,800 for week 4 and week 5. Total payments have been arrived at, and this can be then helped to compute the net movement. The net movement is going to be the receipts minus the payments. And this we can see the net movement in cash is minus 300 for week 1, minus 4,200 for week 2. This means that in weeks 1 and 2, our expenses are going to exceed the receipt from debtors. Then from week 3 to week 6, it is positive. We add to that the balance that we have at the beginning of week 1. And this we were told is 1,000. So giving you a closing balance of cash on week 1, end of week 1, of 700. closing balance is 700, although the movement for the week is negative 300, but because there is an opening balance of 1000, so the balance remains positive at the end of week 1, and that is 700. At the end of week 2, when we do the similar thing, take the opening balance as 700 and look at our receipts and payments. The net movement was 4,200. The opening balance was 700. So this is going to give in week 2 a negative balance of 3,500. Weeks 3, 4, and 5 in similar way, and 6 are all showing positive balances. The manner in which the cash flow has been set out is that we have columns for each week 1 to 6, and we are showing therefore the receipts first of all, and then the payments. We are going to look at the workings in a while to show how the receipts and different payments have been arrived at. But the overall cash flow position is now in front of us: the receipts, the details of the payments, and the closing balance. We can see from this that at the end of week 2, there is a negative closing balance, and the other weeks the closing balance is positive. So one comment that we were required to make as part 2 in this cash flow immediately would be that this negative balance at the end of week 2 somehow will have to be arranged for by the management. They will need to make arrangements so that funds are available to meet this shortage of cash, which is the negative balance at the end of week 2. Looking at the workings, first we'll look at debtors. The way to calculate the receipts from debtors is to see first of all the units sold. We know the price is rupees 60 per unit. So in week 1, the units sold is 400. This is according to the budgeted data given. So week 1 budgeted data shows sales of units of 400 at the price of rupees 60. The sales value is 24,000. Similarly, in week 2, the budget data shows 500 units will be sold. 500 units are sold at a price of rupees 60. That gives a sales value of 30,000. Now, after that, the question says that during the period of the strike, the company expects to sell 400 units per week as long as stocks last. So in week 3, the sale is going to be 400 units, and again the revenue at price 60 is going to be 24,000. And now for week 4, we'll have to calculate the available number of units. We said that the starting position, the opening stock of units was 600, and the production in weeks 1 and week 2 amounts to 1,000 units. So that makes total amount of units available of 1,600. During week 1 and 2 and 3, we are selling 1,300 units. So then in week 4, the balance of the units available is 300. All of those will be sold in week 4. Therefore, going by the available units, the units sold in week 4 are 300 at the price of rupees 60. The sales will be 18,000. And thereafter, there is no more inventory, there is no more production, so there is no more sales and there is no more production. Looking at the cash flow, we said 70% of the cash is received 1 week after the sale and 30% received 1 week subsequently. Then the cash received from the 24,000 being sold in week 1, 70% of that is 16,800 will be received in week 2, and 30%, which is 7,200, will be received in week 3. Of the 30,000 sales of week 2, 70% will be received in week 3, which is 21,000, and 30% will be received in week 4, which is 9,000. Similarly, for the 24,000 and 8,000 of weeks 3 and 4, 70% will be received 1 week after, 30% 2 weeks after. Information regarding current debtors was given to us that 24,000 will be received in week 1 and the balance of 7,200 in week 2. This gives us the working for the total receipts, 24,000 week 1, 24,000 week 2. Now this is the total of cash received in each week. So, for example, in week 2, the 70% of week 1 sales was 16,800 plus the balance of the opening debtors of 7,200, giving you 24,000. Again, in week 3, the 70% of the 30,000 sale of week 2 of 21,000, the 30% of the week 1 sale of 24,000 of 7,200, that gives you 28,200, so on and so forth. It's important to understand this kind of working. It's important to see how the cash flow timing has been taken into account in arriving at the cash balances for each week. This is the amount of cash that is going to be received in each of the weeks from 1 to 6. This is the kind of situation that one is likely to face in the examination or in the assignments, in the questions. You will be given some kind of basis on which cash is received. In actual terms also, in practical terms, cash will be received in some kind of a percentage terms, and credit is usually given and cash is collected subsequent to the sale. The example, therefore, of giving 70% 1 week later and 30% 2 weeks later, that has been used to demonstrate how cash is received in different periods, and therefore it is recorded and shown as inflows in the periods in which it is going to be received. This is a necessary working, and one should be familiar with working like this in preparing cash budgets. The other information that is contained in the question is also important to include in the cash flow according to the timing shown. We were told that the opening debtors are 31,200 and 24,000 was going to be received in week 1 and the balance in week 2. So we included 24,000 in week 1 and the balance of 7,200 was included in week 2. Cash flow timing is important. Cash flow workings need to take into account when cash is going to be received. So this was the detail of the cash received that has been included in the cash budget that we have shown earlier. Now we look at some other workings. Working for creditors. In the same way, according to the information given, materials consumed at 15 rupees per unit. We are told in the price structure that the cost of material is 15 units, and then from our budget data, looking at the production for week 1 was 600 units, so the materials consumed in week 1 will be 9,000. The production for week 2 was shown as 400, and so at the rate of 15, the materials consumed will be 6,000 in week 2. Again, that increase in stock from 7,500 to 11,000 occurring in week 1 is going to require additional funds to increase stocks of 3,500. So the materials purchased in week 1 amount to 12,500 and week 2 they amount to 6,000. The payments to suppliers, we said, was 1 week after they were purchased. So the 12,500 of week 1 purchases will be paid in week 2, and the 6,000 purchased in week 2 will be paid for in week 3. Of the opening balances and amounts due, 8,000 we are given will be paid in week 1. So this gives you the payments to suppliers in the weeks 1, 2, and 3. Same as calculating the amounts received from debtors, we also calculate the payments made to suppliers. In this question, we were told of the production and we were told of the per unit cost of materials. So we could calculate that if the production in week 1 is going to be 600 units, then at the rate of 15, the cost of material consumed would be 9,000. And similarly for week 2, where the production was 400 units, rate was 15 per unit, so 6,000 is the material consumed. Material consumed is material purchased. The payment is 1 week later, so the cash flow is going to reflect the payment when the payment is due and is expected to take place. So the 9,000 of week 1, the payment is timed for week 2, and the 6,000 of week 2 purchases, the payment is timed for week 3. This way, the payments to suppliers have been estimated and calculated and included in the cash budget. Working for wages, we were told that wages are paid 1 week in arrear, and the calculation again is based on our cost structure, where wages were rupees 7 per unit. If the production as was budgeted was 600 units, then at the rate of 7, the cost of wages for week 1 is 4,200. In week 2, the budgeted production was 2,800. At the rate, the budgeted production in week 2 was 400 units. At the rate of 7 amounts to rupees 2,800 for week 2. These payments are going to be made 1 week in arrear. So the 4,200 of week 1 will be paid in week 2, and 2,800 from week 2 is going to be made in week 3. We were also told accrued wages were 3,200, which were to be paid in week 1. Also, for wages, the payments are being included in the cash budget at the time in which the payments are going to be made. We know that the payment for wages is made 1 week in arrears. 1 week in arrears means that week 1 payment will be made in week 2, and week 2 payment will be made in week 3. Accrued wages was given at 3,200. Accrued means wages that have already been, the liability has already been set up, the services have been availed by the company, but payment has not been made. The payment in week 1 of the accrued wages is 3,200. This shows you the payment of wages. Hence, we have timed the wages according to the information given. That payment will be 1 week in arrears. So, wages incurred of week 1 paid in week 2, and week 2 paid in week 3. After week 2, production stops. We have said this is a variable expense. Hence, the payment of wages is no longer going to arise after week 3, which is the payment for production in week 2. The impact we are going to show, and we were required to show, was that of the strike on the cash flow. So as a result of the strike, production in week 3 is going to stop, and no further wages will be made. Payment for wages will be made. Variable expenses, we said, was also paid as incurred. The fixed expenses, however, are going to remain outstanding, and they are continue to be paid for as long as the company can manage and afford to pay them. The rate of payment after the first 2 weeks was 6,800, as reduced by rupees 1,500 per week given in the question. So the cash flow has included fixed overheads payment of 8,300 in week 1 and 2, and 6,800 in weeks 3 onwards. Now this payment will be made according to the cash balances available. So the impact on cash flow, we can see whatever is the balance of cash available, then 6,800 per week is going to be continued to be paid out of those funds as long as funds last. Variable overhead payments are the budgeted production multiplied by the budgeted cost per unit, and fixed overhead payments for weeks 1 and 2 are the 9,000 less depreciation of 700, and fixed overheads for weeks 3 up to 6 are the 8,300 less the 1,500 per week. Now we will look at the balance part of the question. The next part, part 2 of part A of the question, required us to comment on the cash flow. And we said we are going to therefore highlight any aspect of the cash flow that the management should be aware of and they should be informed about. When we saw the cash flow and the cash budget from weeks 1 to 6, we found that 1 week, week 2, was showing a negative balance. So in your comments to management, you will immediately highlight that week 2 is showing a negative balance and therefore funds must be arranged to overcome this shortage. Comments for management. Finance will be required to meet the cash deficit in week 2, but lowering of budgeted material stocks at the end of week 1 would reduce the borrowing at the end of week 2. The comment therefore includes that while you have to make arrangement for funds to meet the shortage, you can also say that if you reduce the purchases of week 1, then the payments required to be made in week 2 will also be reduced. So in this way, they can partly offset the shortage of cash and the need to make outside arrangement. Surplus cash after week 2 should be invested on short-term basis. After week 6, there will be no cash receipts, only outflows of rupees 6,800 per week. The closing balance of 39,700 at the end of week 6 will be sufficient for a further 5 to 6 weeks. This again is a comment. We are incurring fixed overhead cost of 6,800 per week. That payment can go on according to the funds available. So keeping in mind that we have to show the impact of the strike on the cash flows, we will find that there will be a certain sum available, and how long can the fixed expenses be met after taking into account all the receipts and the payments, receipts from debtors, payments to creditors and wages, and then continuing to incur fixed costs. So the impact of the strike on the cash flow will be that whatever cash is available, the organization will be able to meet the fixed cost for that duration of time. We found that the cash flow at the end was 39,700. We are paying 6,800 per week of fixed overheads, so that is going to be close to 5 to 6 weeks, over which time the payments to the fixed overheads can be met. After that, there will be no longer any funds, and the company must come into some kind of production and sales and generate revenue in order to meet the costs thereafter. That's all for today. Thank you very much.